thought with everything going on in the world that we give another update as to what's happening. Obviously, our hearts go out to all the people in the Ukraine. We hope everyone is as safe as they can be. Also, we've had a lot of inflation issues that are going on right now. So we just thought it'd be really good to touch base on, sort of the emotional well-being of investors. But before we get into that, I've had, a few people call me and ask me, like, why are you so calm right now with all the things going on in the market? And I think the people's frame of mind is so important when you want to be successful in investing. And one of the things that was taught right from day one is when you buy something, you don't look at yourself as an investor or a speculator. You actually look at yourself as a business owner. And what does that mean? Well, let's pretend you own the Royal Bank. And last year, the Royal Bank's profits were absolutely fantastic. And you got a great rate of return on your investment. And then this year, your profits are actually even better. Yet your investment return has dropped because of outside factors. So how do I look at it? Well, as a business owner, I look at it and go, well, it's still fantastic. I'm actually even creating more profit than I did the year before, even though short term, I'm not showing those rewards on the valuations of the business. So that's one of the things I really try and have people focus on is pretend you're a business owner. Don't worry so much about what short-term market valuations are in stocks. Worry about whether those underlying assets are making a lot of money or not, because long-term, that's always what dictates what the share price is. I thought we'd ask a few questions, David, and maybe you could answer them and then also back them up with some slides that would help people follow and understand what we're going to talk about. Sure. I thought first I'd ask the question, how does market volatility impact investors?
Yeah, obviously through the regular market cycle, through the peaks and valleys of a market cycle, the vast majority of investors will go through a range of emotions. And the chart that you're seeing now just sort of shows that. When markets are doing well and an investor is seeing positive returns, it's quite common for the investor to feel feelings of optimism, maybe they're excited or even euphoric. When investors are experiencing these good vibes, it often leads them to want to buy more of the same investments which are performing well and causing their positive emotional feedback. When volatility picks up and investment portfolios experience a decline in market value, investors may feel anxious, fearful, depressed, or even experience panic. These types of negative emotional reactions may cause an investor to become dissatisfied with their investment choices and may cause them to sell.
What can investors do to prevent making unforced errors, David?
Yeah, I think that's a great question, Harry. I think as an investor, like we just talked about with emotions, the most important thing to do is to be aware of your temperament. Like, how are you feeling? And will those emotions allow you to make the wrong choice at the wrong time? As humans, none of us are obviously robotic. We all have emotions. We all feel fear at certain times, and when market volatility picks up, it's okay to feel those feelings. After all, you're reading the news, you're seeing headlines. A lot of them are negative when bad things are happening in the world, like there's a war going on or inflation's high. And so it's natural for your fear to kick in. And from a primal sense, all of us, want to seek shelter or seek safety when we do feel fear. And as an investor, that may mean, seeking shelter or seeking safety when you're feeling fearful as an investor may mean selling, moving to cash because, well, at least if I move to cash, I can't lose anymore, right? Well, that is true. You may not lose any more in the short term, but it is a bit of a flawed logic because we always know markets do bounce back. And you want to be invested for when that eventual recovery happens. Typically after a sell-off, the first week, 2 weeks of a recovery, we'll see the biggest intraday recoveries. And if you're sitting on the sideline when that happens, you're not going to bounce back nearly as quickly or as much as if you had just stayed invested. The other problem, which often makes it even worse and more painful, is that people who do move to cash after their portfolios just dropped a bit, and then the recovery starts to happen, is typically they'll stay in cash and say, okay, well, if things still aren't great, it'll probably bounce back or pull back again. And then I'll get in, right? And then it just never does. And then 6 months later, a year later, maybe you're still sitting in cash, and the market's gone all the way back to where it was when you at your last peak. And that's really where that's the cardinal sin of investing. So that's the one thing that you want to certainly be aware of, and that's the biggest unforced error that as an investor you need to avoid making.
Yeah, and I agree with you, David. I can't tell you how many referrals we've had that, a year after a bad market, they come in and they're still in cash, and you're just heartbroken because they've missed the biggest part of the gain already. And it's a very challenging thing then to get them back into the market, already having missed the biggest part of the rebound in there. David, there's a couple of great sayings by some investors. I thought that, I'd have you just sort of give some quotes and then maybe just run through a couple of other slides, helping people to understand some of these issues.
Sure. Yeah. Obviously, everyone knows Warren Buffett, the CEO of Berkshire Hathaway, one of the, best investors for the past, 50 to, 70 years, probably he's been at it. So he said the most important quality for an investor is temperament, not intellect. So the chart you see on your screen shows the number of trades per day going back to 2009. And this really illustrates what Warren Buffett's talking about with that quote. As you can see, the volume of trades executed were 10 times higher in the first quarter of 2020, when the COVID pandemic was starting and panic and fear were spiking, compared to 2009, when the financial crisis was beginning to resolve itself, with government bailouts and things were getting incrementally better at that point in time. This just illustrates that many investors sell indiscriminately when fear kicks in, and they're actually less likely to buy when opportunities are readily available.
There was also a really smart man named Harry Markowitz. He had a pretty good quote as well, didn't he, David?
Yeah, Harry Markowitz was the father of modern portfolio optimization. He's a Nobel Prize winner for his work in economics. And he said that diversification is the only free lunch in finance. The chart you see on your screen looks back at 70 years of market performance in the United States and shows that over no rolling 5-year period would an investor have experienced a negative return if they had 50% of their portfolio in stocks and 50% in bonds. If an investor had all their money in stocks or all their money in bonds, they could have had some negative total returns over certain 5-year rolling periods. And this just illustrates the benefit of diversification, which is always better risk-adjusted returns. And when it comes to investing, that's exactly what we're looking for, is what is the best return we can get per unit of risk that we're willing to assume. And while stocks will always lead to a higher return, historically they've always led to a higher total return over long periods of time, they also come with a lot more volatility. And so that's why having some stocks and some bonds is typically the best solution for most investors.
Yeah, that's great advice, David. As always, if you have questions, please don't hesitate to give David or myself a call. We'd love to hear from you. Take care.